The three bucket strategy is one of the most common retirement investing strategies that is used today. But does it leave wealth on the table? In this video, we're going to talk about what the bucket method is, show why if you're not careful it can be a flat out inferior strategy, and also give some alternative ways to fix this strategy's issues. So here's the general premise behind the bucket strategy. Now, I'm going to explain this strategy using the most common three asset classes that we often see with cash, bonds, and stock. Now, I would push retirees to move beyond just these three asset classes, especially in the last decade of low interest rate environments and now a rising interest rate environment. But the three bucket method is a system in which you lay out, well, three buckets: the short term, intermediate term, and then long-term bucket. Now you can see on the screen which would be the common asset that would fit into each of these buckets. And the main goal of this method is essentially to create distance from you and any market volatility or any volatility within your portfolio. For instance, let's say you put the money that you're going to need for income next year and you put it in stocks. Well, historically speaking, if we put $100,000 in for our income next year, we could theoretically expect that to be $150,000 on the top end and as little as $50,000 if things don't go quite as right. Now that's a wide range for what you have to live off of, and the path to get there can be absolutely gut-wrenching as well. That being said, on a 20-year time horizon, the smallest annualized return the stock market would have earned you would have been right around 6% per year. So stocks are extremely safe in the long term, but can be quite risky in the short term, at least historically speaking. The bucket method takes this consideration and essentially builds your retirement strategy around it, basically looking at a time horizon for dollars within your portfolio. Now, money you need in the next 6 to 24 months is essentially put in the short-term bucket, that cash bucket. Cash is stable and can lose to inflation, but won't do so in a great way over the next, maximum of 24 months, let's say. Then in the middle bucket, you want money that can essentially grow safely, but still ideally outperform inflation over a reasonable period of time. These first two buckets essentially act like a buffer between you and then the stock market. For instance, let's go through a real-world example. Let's say that you retired in 2007, right on the eve of the global financial crisis. Now, this would appear to be a terrible time to retire in hindsight, but the bucket method would appear to do quite well in protecting you from that downturn. During the heart of the market downturn, you would be living off your cash reserves. Once those are exhausted, you then move to that middle bucket, that midterm bucket, all while leaving the long-term bucket completely untouched. We're not continuing to take from that long-term bucket, and so it allows for time to recover and eventually continue to grow. During one of the worst bear markets of the past century, again, this three-bucket strategy would have held up quite nicely. Now, keep in mind with this three-bucket strategy, there is a rinse, wash, and repeat type of method that needs to happen. We essentially need to refresh the money we used up. Once you use your cash reserves, they will need to be replaced so you can continue with this bucket method moving forward. Now, in normal periods of economic growth, it really isn't an issue to rebalance and refresh each of these buckets. As we'll show later, however, this rebalancing approach also creates a core drawback of this method in a market downturn. But before digging into the downsides, there are some notable core benefits that a lot of retirees find with this method. The main one being the real peace of mind benefits that are gained with this strategy. Now, while working, many can handle having 80% of their wealth or more in the stock market because during 2008, you can just continue to work and can continue to contribute towards your investment accounts. You essentially have distance between when you need that money and when we would expect a recovery in the market. Well, we can create a similar situation in retirement, essentially with this bucket method. The other benefit here is it's also a very simple method to understand. It doesn't take a lot of decision making now or much know-how. You place the number of years worth of income that you need in each bucket, and then you rebalance annually. All things being equal, simple should be a variable that we strive for in retirement planning. But the problem here is sometimes not everything is created equal. There are inherent issues with this bucket method, and it primarily comes down to the need to refresh each of these buckets each year. For instance, let's say at the start of the year, your bucket picture looks something like this. You have $1.5 million in retirement assets. You need $80,000 per year. So you put 1 year's worth of income in that first short-term bucket. You put 4 years worth of income in that second intermediate bucket, and then the rest obviously would go in that long-term bucket. Okay, so simple enough. But consider what happens if the stock market were to lose 25% of its value over the next year. What does the bucket strategy look like when we have to rebalance at the end of the year? Well, the $80,000 in the short-term bucket was completely consumed, and so we need to refresh the short-term bucket by now taking $80,000 from that intermediate bucket. However, this will now leave that intermediate bucket too light, so we need to refresh that then from the long-term bucket. So if you're following along this refreshing, every bucket remained unchanged in value except for one, and that would be the long-term bucket. All you really did here was take $80,000 from a bucket that just lost 25% of its value. You put that $80,000 then in the other buckets. On the surface, this bucket strategy seems like it adds value, but once we dig into the actual numbers and year-by-year performance, we really just see it's a little bit of a vanity approach. That peace of mind that you're gaining is really just a vanity metric. You're not actually gaining legitimate benefits inside of your portfolio. It seems safe, but it's really just a fancy way of living off that long-term bucket. The exact thing we were trying to avoid in the first place. So we may need to go back to the drawing board. The premise behind the bucket method seems to be valid, but the practical application leaves a little bit to be desired. Well, here's how you can fix this. All you need to do is put in a simple drawdown trigger. Now, this does complicate the approach, yes, but adds a necessary safety valve. So here's how this would essentially work. In normal economic conditions, you would just rebalance as normal. As the stock market is reaching new highs, you would then shift that given income towards the other buckets, essentially living off that long-term bucket. But on the flip side, when there is a market downturn greater than your drawdown trigger, let's say 20% in this example, you stop refreshing each bucket and instead allow the short-term bucket and the intermediate term bucket to essentially exhaust themselves while waiting for the market to recover. If the recovery fully happens, then you go back to the normal strategy. Once we see that recovery, we refresh those given buckets. This gives you a pure buffer where the safety is actually used up without touching that long-term bucket. So now we gain the benefit of creating that distance between you and the market downturn. In my mind, this is really the only way you can truly accomplish the pure goal of the 3-bucket method. Now we can play around with drawdown triggers and find the exact given drawdown trigger that would have performed best historically. That's not exactly the scope or the goal of this particular video, but we do have an interest in taking this bucket methodology and now comparing it to what is often looked at as the classic portfolio, the classic 60-40. In a classic 60-40 portfolio, you would rebalance annually and you would take everything pro rata, meaning 60% of your income would come from stocks and 40% of your income would come from bonds. Now, here's the interesting finding. If we compare these two common approaches, one is a clear winner from a numbers perspective. Now, we're going to look at data all the way back to 1928. We're going to look at a 30-year retirement, and we're going to use the 4% rule. Now, with the graph on the screen, you will see the classic 60-40 portfolio in dark blue, and then the bucket method in orange. Now, both portfolios end up being a 60-40 portfolio or close to it. And so we're kind of comparing apples to apples. They just rebalance and withdraw income in vastly different ways. You'll notice a varied gap between the two methods, but one thing you'll continually notice is that the bucket method continually loses. In fact, it loses in every single simulation. Now, this is a really surprising finding to most. Now, anytime we analyze any retirement strategy, we need to be cognizant that the numbers won't tell the whole story. If we can theoretically accomplish 95% of a goal and do it 3 times safer, then I think all things being equal, that safer approach is a much better approach to take. I think there are some notable peace of mind benefits from the bucket approach, but know those benefits do come at a cost, at least from a numbers perspective. Now in this example, I used a 20% drawdown trigger, and this could probably be varied and we'd probably find a little bit better results as we played around with certain triggers. But I want to make sure we're not data mining history and finding that the best trigger is 16.78%, and so we use that as a drawdown trigger. I think that is beyond looking at what would practically be beneficial for retirees. So with this quick study, to leave you with a final data point, on average, there is an 11.7% difference in value between the 60-40 method and the bucket method. Now, for certain retirees, this could represent years' worth of income. But why is this the case? Why does a classic 60-40 consistently outperform? We wouldn't necessarily think it would do that much better, just thinking about the dynamics of each of these strategies. Well, I'll give you a perfect example why the 60-40 consistently outperforms. Historically, the stock market has been in an upward trend, where bear markets have really only been a small setback, a blip on the screen, if you will. An annual rebalance 60-40 essentially takes advantage of this ever-rising market. Take a $1.5 million portfolio. We have $600,000 in bonds, $900,000 in stocks. Let's say stocks lose 30% in this example while bonds grow 4%. At the end of the year, with consuming $80,000 of income, you can see the balances before we go ahead and rebalance. They are basically near equal due to stock market losses. The overall portfolio is just shy of $1.2 million. And this is where a classic 60-40 portfolio would have to make a difficult rebalance. They would need to shift their entire portfolio back to a 60-40. This means shifting from bonds that have held up quite well during this market downturn and reinvesting back in stocks that have essentially done horrendous. This is a downright gut-wrenching rebalance for many retirees, but shows exactly why a 60-40 portfolio consistently does better, at least in historical terms. During a market downturn, you're basically adding to the stock portfolio, further betting that it will come back. Historically, it has. In the future, most likely it will continue to do so as well. And this would cater towards a pro rata approach if this was the case, showing slightly better results across time horizons. Now, it's worth noting that very few retirees are willing to follow this rebalancing approach to a T. And so maybe when I look at data between a classic 60-40 and the bucket approach, maybe the classic 60-40 is essentially a false option to compare to. But even if it is a false option, there is one more variation you can make to this bucket approach that maintains peace of mind and actually will show more compelling results than a classic 60-40, even using that pro rata method. And this is something we use with a portion of our clients, and it's called time segmentation. It's a slightly more complex way of managing the bucket system, but we earn benefits for this added complexity. Time segmentation means that as you move forward into the future, you are assigning a time horizon to every dollar within your portfolio. You're essentially matching income liabilities to the safety that you need in, let's say, a 5 to 7 year time horizon. The reason this is more compelling than the bucket strategy is because the bucket strategy is a fairly general approach, where time segmentation is specific and personalized. If you're delaying Social Security, time segmentation will end up having more safety during the bridge phase due to higher income requirements. But then once you shift and you turn Social Security on, then your income need drops. And because of that, you end up having a lot more equity exposure. So this strategy kind of molds together two strategies that we've talked about in the past, with a rising equity glide path as you age, and then the bucket method. We're basically combining these together. And yes, you end up with more safety, but you end up with more equities over the long term that delivers a lot better results. Now, I'll share more detailed numbers in future videos. I'll do a whole breakdown of this strategy. But it has been shown to outperform both the traditional bucket method and a classic 60-40, at least in our simulations and research. And it's not surprising to see why. In our research, time segmentation led to 5.4% higher balances on average at the end of the plan, and led to a 2.5% raw improvement in probability of success, all while still maintaining that peace of mind benefit that we originally gained from the bucket method. As you can see with our example plan on the screen, retirement income needs can often vary heavily from year to year for certain retirees. One year you may have a large trip plan. You may also be performing heavy Roth conversions for a period of time and need extra income freed up to pay conversion taxes. The concept I show on the screen is really just a more detailed approach to this bucket method. Now, in this video, we talked about a 3-bucket method in terms of the short, intermediate, and long-term bucket. These are 3 buckets that can help you think about your retirement investing strategy. But you also have 3 tax buckets with your traditional IRAs, Roth, and taxable accounts. And this video right here will help you determine which of these accounts you should pull from first and how you should manage your optimal withdrawal strategy on an ongoing basis. You can learn more by clicking this video right here. Always remember, you don't need more money, you need a better plan. Thanks for watching.